Hey, UPB from OptionMillionaires.com. We have S&P 500 futures here. Look at the Federal Reserve. They came out at 2 o'clock. We have Ben Bernanke's meeting at 2:30, and then futures just crumbled. Stocks were down. Dow Jones Industrial Average down over 200 points before the market closed, and we had futures drifting lower throughout the overnight session, reaching a low when the European markets opened a couple hours ago and has since bounced off its lows. So where's the markets headed today? Tomorrow we have monthly options expiring tomorrow, so it'll be an interesting day. I was noting in the chat room on Friday, even Thursday, I was seeing in the options that expire this week, the monthly options, I've seen some curious activity, looking like people are hedging themselves for downside. We didn't see it, and if you look at the VIX volatility index, look at the VIX. I mean, yeah, we had the spike up, but nothing dramatic. Actually, we had the opposite. We dropped down to 1536. And even still, if you look at the VXX now, although creeping slowly higher, it's off its highs and still up only a couple percent, which is not something you would see with all of the turmoil we're seeing in the markets. TLT, the 20-year bond fund, has rallied off its lows. It was 109.77 early this morning. That is something that you should look at, keep a close eye on. It's kind of an ambiguous indicator at this stage because we're seeing stocks and bonds rise at the same time in the past. A decline in the value of TLT implies higher interest rates. How is that going to affect stocks? So you look at some of the interest key stocks that, for instance, Verizon. We have LNCO, which I think is going to fall. So does Barron's. Wrote 2 articles about it. Companies that rely upon issuing a dividend to see their stock price rise. Those would be the stocks, the interest rate sensitive kind of stocks that you should be looking at getting out of for shorting, buying puts on if we see TLT continue to decline, which I think it will. Let me pull up a chart of TLT. There it is. You're down with TLT, yeah. You know me. Some beautiful breakouts here from 2011 and now breaking down. Breaking down. It's going to break below 100 and then ultimately down probably back into the 80s, which will be higher interest rates, whether the Federal Reserve wants it or not. Ben Bernanke was doing his live interview, Q&A, and he was talking about being puzzled about higher interest rates. It doesn't make any sense. Federal Reserve is still buying $85 billion a month. Just wild. Our own Ben Bernanke can print all the money he wants and yet cannot manipulate interest rates the way he wants to. That to me sounds like somebody who doesn't have complete control on the situation. So TLT is going to fall. We have GLD and SLV, similar charts, breaking down significantly. GLD is going to fall into the 120s. SLV is going to break back down to about the $17.50, $15 range. It's going to be pretty interesting going forward. And the main focus here that I'm looking at, okay, look at the 5-year chart for the S&P 500. We have this beautiful uptrend from 2009. And then just look recently from the run-up, the Abenomics in November low prices. We've hit the 50-day moving average and the support line all the way up, and now here we are. We're going to break below it today. Break below it with some sort of conviction. It was a muddied picture. I was bringing that up in the chat room. Also, a couple videos I did. This little action here, I was looking for the V bottom. Okay, we'd get a V bottom here. We got it back in April, and if you go further back, each bottom across the 50-day moving average support line would be a nice V bottom where we'd see a capitulation and boom, new highs. Okay, I was looking for that V bottom when we hit the lows here at the 50-day moving average and the support line from November. We didn't get it. We're kind of just muddled around here. We've got these great moves. I think 6 consecutive days with a 100-point swing on the Dow Jones Industrial Average. Just as I'm talking here, we have jobless claims at the highest levels in a couple months. Jobless claims jumped. That's just coming across the wires here. But anyway, the point I'm trying to make is we're going to break below this support line, which is a key support line, and we're drifting lower. That's what it looks like to me. And if you look from a long-term perspective, each time we've drifted lower, okay, we're up in no man's land here. We've made a high, and we make a lower high, we plunge. This was back in 2010. Again, we make a high, a lower high, we plunge. A high, a lower high, we fall. High, lower high, we fall. Back to November. So we have our high, we have our lower high. I believe we're going to fall back to about 155 on the SPY. That's my take, and I think ultimately, long term, the support's still there at about 146 and change. Obviously, as this strings out in time, it'll be a little higher, just like the 50-day moving average. We're going to break that. That's what it looks like. I'm bearish here. Bearish. Let's look at Google. Google broke out its long-term channel to the upside, upgraded a couple times recently, as yesterday to over $1,000 or $1,100, I believe. To me, it's curling. I think Google could still rally in spite of weakness we'll see in the overall stock market. Apple loved it for a possible reversal to the upside. That this low that we've reached recently in the middle of April would be a low that would hold, and that still might hold true. We're below 420 here before the market opens. I still think there's the chance we could ramp up to 500 bucks. That's what this chart's telling me. Obviously, we've dipped below this shoulder here, so that's not a good thing. Might have to throw this one out the window. I'm not trading Apple. We'll see where it goes from here. Let's move to a couple other charts. FCX, 5-year chart, head and shoulders, breaking down to the downside. This will be under 20 bucks. That's what I think is going to happen. Call me crazy. How about GDX? GDX, again, I'll get that line out of there. Breaking down to the downside. It's going to see a move down into the 20s. Pretty crazy from 2009. So we're seeing a lot of things breaking down, and I think the canary in the coal mine, it's what they like to call it, it's the Aussie. The Aussie was at 110 back in 2010 and 11 and has been breaking down. This is the canary dying. The Aussie, the Australian dollar, is a commodity-based currency. We're seeing commodities fall to pieces. And you remember when we crashed back in 2007, we saw commodities, for instance, oil back in 2007. Look at oil. I have to go back a little further. You can see the spike up in oil and then just the massive decline. Kind of foretold the looming collapse of the equity markets. I'm not sure that's what we're going to see this time around, but it's something to keep an eye on. Keep an eye on the Aussie. I brought this up to a couple times. Longer term, this is the reason why I'm not incredibly bearish, but we're in this consolidation phase from 2000 and on to 2013. We finally broke out of it. So to me, this is very bullish for the market. So it's kind of an ambiguous time. We got to really see what's going on with bonds. The last time we had the Federal Reserve come out and the market tanked was in 2011, September 2011, when it came out with Operation Twist. Right here. Do you remember this? Declined and we consolidated, hit our lows in October, never looked back. 107 on the SPY. No, it was 106 something. Anyway, the point being, to a 60% upside almost from that point in time. So it'll be pretty interesting. I mean, we could just be looking at a pullback, kind of a false breakdown, and then there we go. All right, folks, UPB here from OptionMillionaires.com. Everyone have a great trading day. I'll be back on later. Goodbye.